Imagine the year 2008. The financial markets were in freefall. Major institutions collapsed and Main Street braced for impact. Homes were lost, jobs vanished, and a deep, gnawing fear gripped the nation. The public clamored for accountability, demanding a complete overhaul of the opaque, interconnected system that brought the global economy to its knees. This collective cry for change set the stage for one of the most significant pieces of financial legislation in American history. Responding to that demand, President Barack Obama proposed a sweeping overhaul of the United States financial regulatory system, a transformation on a scale not seen since the reforms that followed the Great Depression. This vision became the Dodd-Frank Wall Street Reform and Consumer Protection Act. Signed into law on July 21, 2010, its stated aim was ambitious: to promote financial stability, improve accountability, end taxpayer-funded bailouts, and shield consumers from abusive practices. It was a colossal undertaking touching virtually every corner of the financial services industry. At the heart of Dodd-Frank lay the formidable challenge of ending too big to fail. For years, a theory persisted that certain financial institutions were so large and so intertwined that their collapse would trigger an economic catastrophe, thus necessitating government bailouts. This created a moral hazard where large banks could take on excessive risks, knowing taxpayers would likely cover the losses. Dodd-Frank sought to dismantle this implicit guarantee. It aimed to create a framework for orderly liquidation, preventing widespread panic without relying on public funds. One of Dodd-Frank's most talked-about provisions was the Volcker Rule, named after former Federal Reserve Chairman Paul Volcker. This rule, Section 619 of the Act, directly targeted the risky speculative investments known as proprietary trading. The idea was simple. Banks, particularly those holding insured customer deposits, should not use those deposits to gamble on their own accounts. While Volcker himself envisioned a much simpler four-page ban, the final version of the rule became notoriously complex, complete with various exceptions and a prolonged implementation process that extended for years. To protect everyday Americans, Dodd-Frank established a brand new agency, the Consumer Financial Protection Bureau, or CFPB. Born from the ideas of law professor Elizabeth Warren, the CFPB was tasked with safeguarding consumers from abuses related to credit cards, mortgages, student loans, and a host of other financial products. It writes and enforces rules, examines institutions, and crucially, collects and publishes millions of consumer complaints. The CFPB has since returned billions of dollars to consumers and become a powerful, albeit controversial, advocate for financial fairness. Another critical component was the Financial Stability Oversight Council, or FSOC. This council, chaired by the Treasury Secretary and comprising heads of various financial regulatory agencies, was designed to be the eyes and ears of the financial system. Its purpose was clear: to identify emerging threats to financial stability, promote market discipline, and respond to potential crises. The FSOC can even designate non-bank financial companies as systemically important, subjecting them to stricter oversight by the Federal Reserve, a direct response to the shadow banking issues seen in 2008. Translating Dodd-Frank's thousands of pages into concrete rules was no small feat. Regulators faced intense lobbying from the financial industry, leading to a drawn-out, complex implementation process. Critics from both sides emerged. Some argued the rules were too weak and filled with loopholes. Others argued that they were overly burdensome, particularly for smaller banks. There was a genuine concern that the regulatory load disproportionately affected community banks, potentially stifling economic growth and consolidation within the industry. Indeed, the narrative did not end with Dodd-Frank's passage. Many Republicans and industry groups immediately began pushing for its repeal or significant rollback. This culminated in the Economic Growth, Regulatory Relief, and Consumer Protection Act of 2018, which partially repealed key provisions of Dodd-Frank. This new law exempted dozens of United States banks under a $250 billion asset threshold from some of the stricter banking regulations, aiming to ease compliance burdens and stimulate lending, particularly for smaller institutions. So did Dodd-Frank make banks safer? Federal Reserve Chair Janet Yellen stated that the reforms substantially boosted resilience without unduly limiting credit availability or economic growth. Yet the debate persists. The too-big-to-jail issue, where large financial institutions are seen as too economically vital to face criminal charges, remains a vexing challenge. While the act certainly reshaped the financial landscape, the ongoing tension between regulation and deregulation and the inherent complexities of a global financial system ensure that the question of ultimate safety remains a complex, evolving narrative.